Two-day losing streak on the S&P 500, 20 seconds going into the opening bell. Equity futures bouncing back by 0.5%. This more favourable view of this market endorsed by disinflationary trends continuing in the latest CPI print, the smallest back-to-back gains that we've seen in about 2 years. Equities up, there's your opening bell, switch on the board and get to the bond market. Treasuries running as well, down by about a basis point or so on a 10-year at about 4%. What is it about that level at the moment? The 10-year, 4%. Pretty much every single time at the close over the last 2 weeks, that's exactly where we've been. That's where we are right now. In the FX market, the euro showing some strength, the dollar a little weakness, 110.16 on that currency pair, and crude down by 1%, $83, and let's call it 60 cents. About 20 seconds into the session, your equity market looks like this on the S&P, advancing by 0.5%, on the Nasdaq up by 0.6. One stock to watch at the open, it's Disney, the company, cutting costs and raising prices on most of their streaming offerings. The CEO, Bob Iger, saying important changes are creating a more cost-effective and streamlined approach to our operations. Ed Ludlow has more. Morning, Ed.
Good morning, Jonathan. There is so much news to discuss when it comes to Disney's report, but I think we agree that at the heart of it is cost cutting. You look at EPS in the quarter gone, $1.03, beating expectations. A lot of that demonstration of the work that Iger has done to rein in costs. It's interesting, you look at shares, we're up 3.8%. I know that it's backward looking, but in after hours trade, we were markedly lower for much of the immediate reaction. Then something on the call changed it, and it really was the financial guidance going forward. So starting with the streaming losses, they were $512 million in the quarter gone. Remember that a year ago, the streaming loss was $1 billion, and executives had guided us that for this quarter, it'd be around $750 million. The commentary from Disney was that those streaming losses will continue to narrow and in an accelerated way going into mid-full year 24, and that cost discipline is key. They also talked about exceeding the $5 to $5.5 billion of cost cuts that they are targeting, going past that target. What the market really liked during the call as well was the content spend narrative. It's going to be about $27 billion, down from previously projected $30 billion. That was seen as a massive positive. The streaming business is always in focus. It did drop from a subscriber basis 7.4% in the quarter gone, missing expectations. That's almost all largely attributable to Disney Plus Hotstar, the brand in India and the Middle East. And you'll remember that they did not renew the India Premier League cricket rights. The net result was that for Disney Hotstar, subscribers dropped 25%. The CapEx guide was also lower than previously guided and what the street was expecting. All told, this is Iger saying we're committed to these cost cuts, and they're starting to show the fruits of their labors in that sense. In terms of what happens to drive growth of the subscriber base, they do see it accelerating into the fiscal fourth quarter, which is the period ending September. But really, it's all about discipline. I know that's a boring story, John, but that is what the market's cheering this morning.
But Ed, to build on that, how much of it was about discipline? How much of it was about the strikes on the West Coast in Hollywood?
Really good question. Go straight to the content spend guide, $27 billion instead of $30 billion. You cannot make or spend on content if you don't have the writers to think about the programs. That was a point of discussion. But remember, I think you and I discussed this at Sun Valley. There are two competing forces when it comes to the streaming businesses that want to be profitable. They're conscious of pulling back spending, but at the same time, you need the content slate to drive the subscriber growth. And I think that, Iger was pretty sanguine that in the end, the writers or actors strike aside, they've got the balance right in what they plan to spend versus added new material to the existing platforms.
You need the content,
and they raise prices
as well.
Sorry,
Well, Ed, that's
right,
my point.
Sorry.
Do they believe the tolerance is there for higher prices?
Yeah, and 4 red headlines on the Bloomberg terminal in this earnings, a lot to keep up with. So Disney Plus without ads rises 27%, $14 a month up from $11 a month. But they seem, based on the data they have of those selecting the ad-supported tier and those that are not, super confident that there is enough content there to justify a premium price point. Hulu, ad-free, jumps 20% to $18 a month. So it was a really interesting move by them. It did surprise the market a little. But I go back to what moved the needle on the stock in after hours. It was the financial guidance on spending.
Ed, thank you, mate. Great coverage, as always, on that name. That stock is up by 2.6%. Let's stick with Disney. Morgan Stanley reiterating its overweight rating after the earnings, saying this: Disney continues to benefit from its park segment, this is important, which we see driving consolidated earnings for years to come. This is a real investment positive as Disney takes meaningful but challenging steps towards improving its earnings power. We're higher there by a little more than 2%. Those gains fading just a little bit. Big acquisition this morning in the retail space. Shares of Capri are soaring after Tapestry agreed to acquire the luxury retailer in a deal worth $8.5 billion. Capri's CEO saying this: we're confident this combination will deliver immediate value by joining with Tapestry. We'll have greater resources and capabilities to accelerate the expansion of our global reach. Abby has more. Hey, Abby.
Hey, John. So yes, the multi-year trend of consolidation in luxury retail continues. As you mentioned, Tapestry is buying Capri Holdings for $8.5 billion. That equates to $57 per share, a 65% premium. And of course, Capri owns Michael Kors, Jimmy Choo, Versace. Now, the two companies have actually been in talks for months, so this is not truly a surprise. It's more of a surprise, but the stock is clearly surprised given the fact that right now it's up 56.5%, its best day ever going back to its trading history of 2011. Both companies have been building themselves up in recent years to compete with the likes of LVMH and Kering, but the feeling is they were really no match. So now Wells Fargo is saying that because because Tapestry will have its Coach brands and there's Stuart Weitzman and other brands that it has, but with Capri it's now going to also have the Michael Kors and the Jimmy Choo brands, that they are going to be the leader, the number one player in what they are calling accessible luxury. Plus, China is a big opportunity. Tapestry has been doing great in China. About 15% of their revenue comes from there. For Michael Kors and some of those other Capri brands, it's been closer to 6%. Capri's weakness this year has been blamed on consumer spending weakness there. Tapestry into today up 8%. Again, Capri had been down big. Now they're both basically flat. So it's interesting to see this evening of the playing field here, John. And while Capri is not quite at that price of $57 per share, it's close enough that it suggests folks think the deal will go through.
Quite a move. Abby, thank you. Capri up by 57% in early trading, about 6 or 7 minutes in. Let's turn to the pharma space. Shares of Novo Nordisk falling for a second day after touching an all-time high. The company's CEO discussing the challenges of meeting surging demand for its new obesity drug.
I'm not concerned at all. We want to make sure that patients who start on treatment can stay on treatment, so we will keep restricting a bit the starter doses in the US to make sure that patients can have a good experience. We have all dose strengths available in the US. We are increasing manufacturing, so this is indeed a very, very positive outlook.
Simone has more. Hey, Simone.
Hey, John. Yeah, this is the same problem that Novo Nordisk has been facing ever since June 2021 when its weight loss drug Wegovy was approved by the FDA. The day after, it was the second most Googled item. Now it's still going to have to continue restricting supply of Wegovy in the United States, especially at some of its lower doses, because it simply doesn't have all the supply it needs to meet demand. I mean, we saw from earnings today sales falling short of expectations, but enormous numbers here, 54.3 billion Danish krona versus the 55.1 billion expected, but the company did raise its outlook for sales and earnings for the year, mainly on the back of these GLP-1 drugs, both for diabetes type 2 as well as weight loss. Its big blockbusters, Wegovy and Ozempic, coming in well ahead of sales expectations. You know, the question here is, one, what kind of competition does Novo Nordisk begin to see from its competitors, especially Eli Lilly, which has Mounjaro, likely to be approved by the FDA for weight loss later this year. That one's seen as maybe even a little bit better than the Wegovy option in terms of weight loss. But, you know, it's such a large market. Jeffrey says $150 billion for weight loss drugs by 2030, that it may not really matter. So then if the concern is simply keeping up with the kind of demand, how much is Novo Nordisk falling behind? And how much is this simply where we're seeing a price that's above analysts' targets? The street has looking for 12.05. We're at 12.40 at the moment.
Running so hard, so fast. Not a bad problem to have when you think about it. Simone, thank you. Let's get back to the earnings. Shares of Wynn Resorts Resorts jumping on better than estimated Q2 earnings. The upside results driven by pent-up demand out of Macau. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, currently Wynn shares higher by about 4%. That's after reporting yesterday after the bell that second quarter adjusted EPS came in at 91 cents. Analysts were looking for just 62 cents, so a big beat there. Also on second quarter operating revenue, that came in at $1.6 billion. A little bit of a beat as well. The estimate had been for $1.53 billion. And getting specific, Las Vegas did pretty well, but as you mentioned, it was Macau that really shined. Wynn Macau's hotel saw revenue of over $300 million. You compare that to a year ago, it was below $59 million. And checking in on the sell side, Jefferies wrote that it was the Macau properties that generated the greatest upside to the bank's forecast, and Stifel raised its price target on the heels of these results. And looking ahead, while it wasn't a factor in what we learned yesterday, Wynn also said that it expects to obtain a gaming license in the United Arab Emirates soon. And if that happens, John, that would be the Gulf region's first casino resort.
Katie, the stock's up by 3.8%. Katie, thanks for the update. This market rallying, nothing to challenge that soft landing narrative in the economic data we've had so far. In the last hour, CPI in line with expectations, the S&P up by 0.9%. Joining us now is Sarah Malik, CIO at Nuveen. Sarah, wonderful to have you with us on the program. It always is. This line in your research, you said you are in the lower is over camp. What does that mean, Sarah, after the data we've seen in the last hour?
Well, I think today's CPI number does support a pause for the Fed in September, but the door's open for a hike in November. We generally think that inflation is going to have a hard time hitting its 2% target that the Fed has set. So we see structurally higher inflation and interest rates for a while. We also don't see rate cuts in 2024. The market's pricing in about 3 to 4 rate cuts. Now, two things we did like about today's inflation number was the moderation in these two wild cards of used cars and also other areas of inflation that have been volatile over the recent period. But two areas that we're watching are energy going forward. We think that that's going to become a part of inflation that moves higher in the future, and also shelter prices. Real-time data is showing us that that's starting to moderate. We're hoping that continues to do so. But used car and airfares are two areas of inflation that we're glad to see those down in today's number. But they're very volatile. That's what we've seen in history.
Sarah, what are the factors behind this resilient economic growth we've had in America that you think will persist beyond, say, the summer into next year?
Two factors have been consumer and employment. Employment markets have remained strong. Last July's payroll numbers coming in at 187,000 is still a number that supports economic growth. Consumers have been spending, and that's what's been holding up the economy. As long as people are employed, they tend to continue to spend even during inflationary periods, and that's what we're seeing. As long as that continues, I think then the economy will continue to grow. We are concerned about the employment markets, though. They are starting to show some cracks. If that happens, I think the consumer does slow going forward, and that will get us into a mild recession. However, that is not our call for 2023, but we may see more of that in 2024.
Let's lift the lid on this equity market together and go through it sector to sector. Sarah, where do you think in this economy right now there is still pricing power for these companies?
Yeah, we're seeing pricing power. Margins for this quarter of earnings are actually holding up much better than people expected. We're seeing companies hold on to pricing while getting the benefit of lower inflation in their cost basis. That's good for margins. But earnings have been interesting in the sense that about 3/4 of companies have beat earnings during the second quarter by a rate of about 7%. But stock prices are not reacting positively to that. Stocks are actually down, having the worst reaction to positive earnings that we've seen in about a decade. So that's not great for earnings. That's showing less health for the market. The leader being technology, which now has been very weak, trading at about its 50-day moving average. We'll see where it goes from here. But tech stocks really just have not been reporting earnings that are good enough to please investors, given the stock price run that we've seen this year in that sector.
We've had so much multiple expansion, Sarah. Where are you expecting the earnings growth to come from?
Well, most of this year has been driven by valuation expansion, and that's been the issue, is that how much further can earnings go? We're already seeing margins hold up well. Pricing power probably is at risk as inflation starts to decline and continues to decline from here. So I think that's the issue. If earnings cannot continue to grow, I think valuations for the markets are at a premium. we're going into, we're in the second half of August here where liquidity tends to be light. I think market moves will be exacerbated. Some of the things I'm worried about are earnings where we're not seeing a healthy earnings market in terms of stock prices. Also, the Moody's downgrade of banks, I think, and their credit ratings is an issue. Energy prices going up, that's inflationary. And even China trade data came in poorly. And then finally, you touched on it earlier, the 10-year is at 4%, and that's a headwind for equity. So with valuations where they are, there's a handful of headwinds for equity going forward. So I think markets at best are in a trading range and maybe even are at, a short-term peak at this level.
This sounds super defensive. So final question, Sarah. Top picks, where are they right now for you?
Top picks. Yeah, and one sector we like a lot, it's not a sector, just a category, is dividend growers. These are stocks that have underperformed year to date. They're companies that tend to grow their dividends. They're resilient in down markets. They have nice up market capture, but they don't perform as poorly as the markets do on the downside. They've lagged a lot year to date. Many tech companies don't pay dividends. So this sector's been left behind. I think this could have a catch-up trade if the market turns more defensive because of these headwinds that we talked about.
Sarah, great to get your input on the program. Sarah Maliker, thank you as always for jumping on with us on a busy morning for everyone. About 15 minutes into the session, equities up by 0.9% on the S&P 500. Coming up, investors digesting the latest inflation report.
I think the reacceleration story for inflation, it's really about, in my view, is the economy growing above trend or not? And I think the economy is growing above trend.
Neil Dutta thinks this can continue. Team coverage up next.
I think the reacceleration story for inflation, it's really about, in my view, is the economy growing above trend or not? And I think the economy is growing above trend. I don't think the Fed has done enough. I do think that there is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up, sometime next year.
Neil Dutta of Renmac, I don't think the Fed has done enough. Those comments coming after a subdued inflation print in America about an hour ago, core CPI posting the smallest back-to-back increase in 2 years, leaving the door wide open for a Fed pause in September. Let's get to the team coverage. Bloomberg's Mike McKee, Ira Jersey joining us from Bloomberg Intelligence. Mike, first to you. That thesis, that argument people are presenting at the moment, the prospect that inflation can re-accelerate.
Yeah, let's run through this a little bit. On the Bloomberg, if you have a Bloomberg, you too can be a quant. We have a great program called ECAN, which breaks down all of the information in these economic releases into little bite-sized pieces you can see. And the first thing I want to show is what's happened up to now. We're seeing basically a trend that looks very good of not only inflation falling, but the contributors to inflation getting smaller every month. The only thing that really changed in the last month is the red there, energy, a little bit less of a subtraction from CPI, but everything else looks like it's getting better. But that's not what some people in the markets are seeing, and I'm sure Neil Dutta is thinking this too. You look at inflation forwards, five-year forwards, and what are they telling you? They're telling you that people think inflation after 5 years or over 5 years is going to be going up again. That has turned around in the last couple of weeks as financial conditions have eased, which is a real concern. And then what you have to look at is the yield curve, and you've seen that, John, invert in great detail, and now it's starting to go the other way. And the thing is, recessions don't start until the yield curve uninverts and the Fed starts cutting rates. And so is this a dangerous moment? That's what the Fed has to decide.
That uninversion, if we can call it that, that re-steepening, Ira, led by the long end. Usually when you're going into recession, it's the Fed cutting and you get this bull steepener with the front end rallying. It's been the long end selling off. Ira, what do you make of that over the last, not just this morning, the last month?
Yeah, so really the last couple of weeks, it's been a big part of the supply issue that you've seen the long end start to creep higher and versus the short end. So usually bear steepening, like you've seen over the last couple of weeks, usually does not persist for very long periods of time, and I wouldn't expect it to this time as well. We have supply. We had supply yesterday, 10-year auction. Today we have a 30-year auction. I think after that, the supply story won't persist until, of course, we get additional supply next month. So we're in a situation right now where everyone's trying to do exactly what you're talking about, John. Will inflation reaccelerate? So there's a part of the market and a part of the rates market participants that are suggesting that we could see a reacceleration of inflation. So what does that mean for the curve? I think from my perspective, the single biggest thing that the Fed needs to do is try to get some of the cuts priced out for next year, because those easing of financial conditions that Mike just talked about is in large part because the market is still expecting interest rate cuts next year. You price those out, and that's just as good as hiking in November if you say don't have a hike until the second half of next year.
Well, the Fed is entertaining that conversation to some extent for 2024. Ira Jersey, thank you, sir. I wanted to squeeze this in again. Mike McKee, happy birthday. We love you. Have a great day. Thanks for sharing your day with us on Inflation Day in America. Let's get you some sector price action. Here's Abby.
Well, stocks are higher on Mike McKee's birthday day, a real risk-on mood, maybe celebrating, up more than 1%. And we have all the big tech, mega-cap tech sectors really rebounding here, John, up more than 1%. The worst sectors are utilities, real estate, and industrial. So utilities, of course, defensive. So that is risk-on that they're underperforming. As for one interesting area, the overall solar area is higher, up 1%. But you can see Plug Power absolutely plunging, this as gross margins disappoint.
Abby, thank you. Your trading diary up next. We've made progress while maintaining a strong economy. The words of the president in a statement from the White House just moments ago following the inflation report, a disinflation report over the last couple of months. Your equity market doing nicely up 1% on the S&P. That's the price action. Here's the trading diary. The US Treasury selling another $23 billion in 30-year bonds at 1 p.m. Eastern time. Shortly afterwards, the president continues his Bidenomics tour with remarks from Utah. Atlanta Fed President Raphael Bostic, Philly Fed President Patrick Harker speaking this afternoon. And finally tomorrow, rounding out the week with US PPI and the UMich Consumer Sentiment Survey. From New York City, that rounds out the morning for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Got that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, August 10th. Here are the top market stories that we're following for you at this hour. Summer of disinflation. Core CPI posting its smallest monthly increase in 2 years. We're going to tackle just how long prices can fall. And caught offside, you got equities up almost 2% for the NASDAQ 100. Money comes out of the front end, yields lower. We're going to talk to Ann Walsh, Guggenheim Partners CIO, about the biggest misprice in the market right now. And Coach, meet Michael Kors. Tapestry buys Capri
Capri for $8.5 billion, creating a luxury behemoth. Can it compete against the European heavyweights? From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, the market reaction in and of itself really isn't a surprise to CPI data. I think the question is just how that disinflation trajectory moves from here.
I think that's the key question. There are plenty in the market that believe that inflation could reaccelerate from here, or at least stabilize here. And then you've got to think about the implications of that. The market's still got cuts priced in fairly early on next year. What are we, May, when the first price cut comes in?
Like a full cut in May.
Is that the reality of the situation here, or is the Fed going to look at the risk that inflation reaccelerates and say, actually, we want to keep the insurance policy of higher rates for longer? And I think that's the question that the market has now got to grapple with. I think the claims number today is interesting as well. What is happening within the labor market is critical within all of this. But how much more good news are we going to get on inflation, I think remains the kind of the core question that I think the market still doesn't have an answer to.
Yeah, and it seems like equities were sort of telling the right story versus the bond market over the last 6 months, and I wonder if that changes over the next coming 6 months.
Yep. Equity markets got dinged up yesterday. I think you got to take yesterday into account. Think about what is happening there as well. Think about what's been happening over the last few days. There's a little bit of relief here, maybe a little bit of positioning unwinding, but I don't think there's a clear narrative that comes out of this. I think Mike McKee will probably tell us this in a moment. This is a consequential but completely inconsequential set of numbers.
Yeah, I was also going to say it's a Thursday in August, so volume is up a bit compared to yesterday, but you can make an argument putting on positions, then you're going to go to the beach, check out on Monday kind of thing.
It doesn't particularly bode well for volumes tomorrow, does it? Friday, weather's nice, let's get out of here. Anyway, our question of the day is a fairly straightforward one. We've seen the data, we now know what it tells us. Is the summer of disinflation now over? Let's bring in the birthday boy, Mike McKee, and MLive macro strategist, Simon White. You are the birthday boy, so you get the first question.
Like
you usually get the last question. Yeah, little halo. We won't ask how many candles there are, but we'll maybe do that offline. Mike, let's talk about inflation from a different kind of inflation. Is the inflation numbers we've seen today, what do they tell us about the longer term trend? We have seen disinflationary tendencies in the recent data. Inflation is clearly coming down. Is the delta changing? Are the components changing? There are many in the market that still believe that there is a significant danger that inflation reaccelerates from here. I think you put your finger on it when you said, is the delta changing? Because the one thing that stands out in this report is that there were a lot of categories that showed inflation, but the gains, the month-over-month change in the percentage gains have gotten much smaller. It's not so much a question of things that went down, although a number of things like used cars and airfares did fall. But the inflation rates for most of these categories are starting to fall back to the to where they should be or should have been in a 2% inflation environment, granting that before the pandemic we had a less than 2%. But this is about what the Fed wants to see. Now, does it continue? Probably for a month or two, because there are still downward pressures on used cars and airfares. And one interesting thing, and this would fit into your interest group, Guy, natural gas prices went up a lot here in the United States last month because everybody turned on their air conditioners.
Yep. Yeah.
Well, they're going to start turning those off again, and we'll see maybe other fuels rise a little bit, but that'll take some pressure off once we get into September and October. So yeah, you'll still see this for a little while. Mm-hmm. The question is, what happens after that?
Exactly. So if the summer of disinflation is over, do we just see more volatility in the disinflation narrative? Simon, you weigh in.
Yeah, I'm trying to think of something negative to say, as that's what you normally expect from
you
me.
You can do it. I have
the accent.
It goes with the accent, exactly. Portent of doom. Yeah, I think there's two things here. I think there's the inflation numbers, which I think you will see more disinflation over the next few months. But inflation is a very lagging variable. So it's really telling you about inflation you've already experienced.
Yeah.
So in that case, I think the market is going to be much more alert to signs of inflation reaccelerating and not waiting to see it in the numbers, because by that point, it's probably going to be too late. So that's why things like the commodity rally is very interesting, which is broadening. You've now had 2/3 of exchange-traded commodities have rallied over the last month. Obviously, we've seen oil has rallied. Non-exchange-traded commodities are beginning to rally as well. If you look at the global food index, that's also began to rise. So The market, I think, is much more alert now. At the end of the Fed cycle, it's kind of like when inflation was rising, it's dependent on, what the Fed's going to do. But now we're towards the end of the cycle. The Fed is not quite as important as it was. So in which case, the market is going to have to be more keyed up to other inflationary signs and not waiting to see it in the CPI data.
The big conundrum that I face right now is, which is the biggest threat for the market? Is it that actually we get a recession, or is it that we get a re-acceleration of inflation? And are those two things distinct risks, or is there a danger that the Venn diagram overlaps as well?
I think the inflation one, because that is not priced. If you want to get an idea of what markets are potentially pricing, you can look at CPI fixing swaps. And they're probably your best near-term guess of what the market thinks CPI is going to be over the next few months. And there's a clear disinflationary trend. So for the next year, it's expecting to see inflation back down to 2.25, 2.5. Right? It's a very steady, a couple of bumps, but a very steady disinflationary trend. So clearly the market is not ready for a re-acceleration in inflation. I think what happened last week was very interesting in the US, where you had the supply concerns, which are basically inflationary concerns. The market tried to sniff that out ahead of any inflation numbers.
And then, Guy, there's been some writing about this too, that just in terms of trading positions, like there's only two things that can really move the needle from here, like a material shift, and that's going to be a real acceleration of inflation or a crash in the economy. Like if we priced out the hard landing, we sort of priced in the soft. You need something along those lines to be a dramatic shock.
Absolutely. At the moment, the market's in the middle. And it's got a big warm blanket around it, and it's comfortable, it's got a nice drink, it's kind of watching the world go by. Life is good. But those two kind of risks are not there. Now, I think, to Simon's point, I think there is a greater understanding and awareness of the fact that things could go sideways and then we actually see a recession emerging. That is still being talked about. But the dragon that is inflation feels like it's been beaten right now.
Yeah.
And that's where, if you were looking for a gap in the market, that's probably where it is.
There are a lot of images there.
It's so hard to judge, because you're trying to, as Simon says, you're trying to sort of piece together a lot of anecdotal evidence at the moment to try and form a single picture. And I think it's really unclear, and it's the summer, and everybody's kind of chilled out. But I think come September, October, I think it gets much more interesting.
So, Mike, I guess that brings in then for the Fed, okay, they get a skip for September, but clearly the reacceleration of inflation is the bigger risk that they see versus, say, a growth crash, yes? And I wonder how they start to view those two.
Well, remember, there are two more inflation reports before their September meeting. So this, as I had said earlier, is probably the least consequential, most important data release of the month, because things could easily turn around. But if we see the same kind of numbers before the next meeting, then they can skip. But they are going to have to emphasize that they're not going to be cutting rates anytime soon.
They don't want that to get priced back in.
Because what we're seeing... How do they do that, Mike? How do they get the market to believe them on that? Well, they're going to have to repeat that over and over again. I don't know if it's something Jay Powell wants to bring up in Jackson Hole. Probably could. But as you can see, it's not until the Fed starts cutting and the yield curve starts uninverting that we get recessions. And so the Fed doesn't want anybody to think they're going to be cutting anytime soon. And the markets are beginning to price that in. Now, the Fed may cut next year if inflation continues to fall, because real rates will rise, but they will just cut in proportion to that. They won't be cutting because of a problem with the economy. So they've got to walk that fine line. You're seeing already that financial conditions have eased, and that has started that uninversion of the yield curve. So the question is, how do they keep that from going farther? And we see the possibility of inflation rising again, particularly in commodities, particularly in energy. And the Fed can't do anything about those, unfortunately.
But
so
it does affect
is tricky.
Expectations and sentiment, and then they do look at that in terms of inflation expectations. So they're like the feedback.
You look at forwards, and they're already five-year forward is already pricing an uptick in inflation.
Yeah. All right, guys. Thanks a lot. I really appreciate it, Mike and Simon. Appreciate you both joining us. Coming up, more insight to the question of the day: is the summer of disinflation over? Catherine Rooney-Vera, StoneX Financial Chief Market Strategist, joins us next. This is Bloomberg.
season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
It's going to be a roller coaster. I think we're seeing now that the downside of that roller coaster. I think that's going to lead to some way up as well. So maybe amplification of the roller coaster is one of the a story that comes out of this for the next few months. But it is an unambiguously great progress over the last 3 months we've seen.
That was Jean Bovin, BlackRock Investment Institute head, reacting to this morning's CPI data, which brings us to the question of the day. Is the summer of disinflation over? Joining us now, Catherine Rooney-Vera, StoneX Financial Chief Market Strategist. Catherine, in some ways it feels really binary, right? It keeps going down or it goes up. Like those are the only two options and has a lot of repercussions in the market. What do you think? Is the summer of disinflation over?
Well, I think disinflation is continuing through year-end. My forecasts for core PCE are for 3.8% by year-end 2023. My concern, however, and Mohamed El-Erian put it very, very nicely visually, is that inflation becomes takes a smile visual, and that is that we get a reacceleration in 2024. The Atlanta Fed, in their nowcast, put out an estimate for 3Q of 4.1%. I have 1.8 in my forecast. 4.1% is double potential growth here in the United States. So if we, in fact, get numbers even close to 4% for 3Q after 2 and change in 2Q, plus real wages positive and trending higher, plus consumer confidence robust, plus 3.5% unemployment and a red-hot labor market that's still strong. It's slightly rolling over, but still strong. Then I think it's very unlikely that we get service sector inflation in a service-based economy sufficiently contracting to get to the 2% core PCE target. So next year, Guy, I think 2024 is going to be, the Fed's got to choose. They've got to choose if they have a strict interpretation of their dual mandate or if they change it.
I hear what you're saying, and they've got to figure out how they deal with these cuts that are currently priced in. We were talking about that just a moment ago. Catherine, to what extent is the market broadly priced for that? How big a shock would that be for assets? Which assets would react the most in that kind of environment? Say the Fed sticks with the idea that it has to get inflation back down to 2%, and inflation ain't going in that direction. How big a market adjustment do we need to see, and where?
The best trade right now, Guy, in my view, is counter-cyclical portfolio policy. That's preparing for the worst. Because right now the markets are pricing in the best possible scenario. And as we know, that generally doesn't play out. There's going to be kinks in the road. So 100 basis points around there of cuts next year, in my view, is very unlikely to happen. Inflation could be sticky around 4%. It could reaccelerate or just not come down from 4 to 2%. The heavy lift is going to be core PCE going from 4 to 2, not headline from 9 to 3. So what I like right now is last week on Bloomberg, I recommended naked puts on triple Qs. It's worked out really well. Cash, 5.5%, looking really good. Gold, but even short duration tips make sense to me because Jan 2025's, for example, real yields 3%, nominal 5%. The implied inflation there is 2%. If inflation remains sticky around 4 or just isn't 2, then you get a nice return from tips of about 7%, the 4 plus the 3%. So I think that's another way to protect portfolios right now.
So, Guy, this also brings into question sort of the long end of the bond market, for example, because I feel like hedge funds are shorting and asset managers are buying. And I feel like it sets up a term premium increase that we haven't really seen. And I kind of wonder if, in terms of the long end, we're in a dicier spot, Guy, when it comes to potentially the disinflation ending.
In some ways, long-term asset managers have to hold some of this stuff, so they're buying it for that reason. Exactly. I think an elevated term premium story is is an interesting one. I was listening to Ira talking about this a little earlier. He says that you kind of get these phenomena that don't last very long. At the moment it's being driven a lot by supply. But normally you'd be expecting the market to steepen in a completely different way. And this is the point. You'd expect short rates to come down. We're not seeing that. We're seeing the exact opposite. It's just confusing as to what is happening here. Catherine, what message is the long end telling us?
It's so fascinating. I couldn't agree more with you, Guy. I mean, if you look at the push-pull on the 10-year, you have inordinate fiscal deficits. You have a big supply coming out of Treasury. You have the Japanese yield curve control kind of going away or expanding the ability for yields to rise. That incorporates repatriation of capital. So that's negative for the 10-year yield. But then on the flip side, you have the Fed coming to the end of its target, and you have peaking inflation. So I think there is a push-pull there. The recommendation at StoneX we had last week was on steepeners. It worked out really well. I think, however, that if you have the perspective that I have, which is that there's a real chance of inflation reacceleration, then you're going to want to be careful and perhaps the opposite. Play a flatten or play the payer receiver. You can pay fixed, receive floating. I think that makes sense. I think the markets are discounting a continuation of disinflation. I've never been a believer of immaculate disinflation. It just doesn't make sense in a consumption-based economy with a strong full employment and real wages finally turning positive.
So I know you mentioned gold earlier. So is that like a strong buy commodity call then, if we're going to prep for that acceleration?
I wouldn't go through the whole commodity complex. I think China is not going to come with this massive stimulus that we've historically seen in the past. So it's more of a play on inflation potentially surprising to the upside. So I like having that safety net, the cash, the gold, the sectors. I think Guy or your previous guest mentioned how certain sectors, I think it was Mike McKee, how the economy, starts to contract after the yield curve has bottomed out. And that's correct. So if that's correct, after the yield curve has bottomed in terms of inversion, you want to be long defensives. You want to be long staples, utilities, healthcare, and energy.
Yeah, all of this is happening at the same time, Catherine, as the government continues to support this economy, continues to pump money into the system, continues to provide an economy backstop that is totally different to one we've seen for a while. The government is keeping the economy going and looks like it wants to do so for a while. How does that change the narrative?
Well, a lot of people compare the rating downgrade to 2011, and there are some similarities, but what isn't similar is the trajectory of the fiscal deficit and debt at this juncture. The U.S., in many aspects, the ratios are comparable more to the emerging market names, but still enjoy massive investment grade ratings. So why is that sustainable? Because we have the U.S. dollar. It's the sovereign reserve currency of the world. There is no substitute. Until there is, we can keep this party going. China has $3 trillion in reserves. The deepest, most liquid market is treasuries, and they're going to continue to support that market. I do, however, think that there's going to be a hard look, and I think the fiscal situation merited this downgrade. It makes no sense, in my perspective, for the U.S. government to be running a near 9% fiscal deficit when we have, at this moment, full employment. We need to be engaging in counter-cyclical fiscal policy, not pro-cyclical.
Catherine, great to see you as ever. Thank you very much indeed for stopping by. Catherine Rooney-Vera, StoneX Financial. Always great to see you. Thank you very much. Still ahead. It's not all magic in Disney's kingdom. The entertainment giant reporting mixed results, announcing double-digit price hikes for Disney Plus streaming, the Disney Plus streaming business. Shares have been pretty volatile over the last 24 hours. We'll figure out why next. The startup is coming. This is Bloomberg.
It's 23 past 7 on the West Coast. Want to get to the startup, where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Ed Ludlow, the host of Bloomberg Technology. Ed, it's been almost 12 hours since Disney reported. What is Silicon Valley talking about in terms of the release at this point? I think that they're talking about profitability in the streaming unit actually being real. You know, everyone is comparing Disney to Netflix on a subscriber basis. Warner Brothers Discovery is coming in there too. What they all have in common is that they disclose subscriber base. In the quarter gone, Disney subscribers overall fell 7.4%. They missed estimates. It was a surprise. But the core of that story was a content story, which Guy's going to love. Almost all of the subscriber miss is attributable to Disney Plus Hotstar. That's the brand in India and the Middle East. That fell 25% in the quarter. Why? They didn't renew the India Premier League cricket rights. That's the story. Content is king.
Yep. It's a massive story, certainly in India. It's interesting cricket's going into the States. I have to say, English cricket, watching that very carefully. Ed, what is the long term? Is this company, does it want to be in the TV business? Does it always, defining TV is difficult, but does it want to be in linear TV in the way that it has been previously? Is that changing?
It's a great question, because profit at what we call the legacy or live TV business dropped 11% year on year. What we're talking about is things like ABC, ESPN, and even as far back as Sun Valley, Bob Iger had sort of hinted that they're not necessarily core to the strategy. On the analyst call, one analyst asked if we fully now depreciated the value of those units, and you know, a lot of focus what he was asked about was about subscriber growth, getting profitability on the streaming business or online video business, but the cost cuts broadly also address TV, which is suffering from falling ad revenues. It's incredibly expensive to make live television. A lot of people have told me in recent weeks, we love that Iger's staying on because he's so committed to live sports, but if you listen to what he had to say on the call, they're looking for partners to do that live coverage outside of their own core linear offering. Interesting. Do we think, I mean, you have like 10 seconds. Do we think if all of a sudden the live TV, linear TV went away, you get a boost in the stock? No, the stock boost was literally the boring grey stuff the CFO said about CapEx. Content spending will be 27 billion instead of 30 billion. You know, that's what the street wanted to hear, and that's what they got.
Ludlow on Disney. Thank you very much indeed, Ed. Great to see you. Bloomberg Technology coming up in around 90 minutes time. Coming up on this show, more on our question of the day. Is the summer of disinflation over? And Walsh is going to join us.
authority.
We're about an hour into U.S. trading session. Tech outperforming. Volume also not terrible either. Abigail's tracking the moves. Abigail?
Yeah, we've got a real rally on our hands. We have this risk-on mood coming after a couple of down days for the S&P 500. Investors really liking the CPI report that's a bit tamer or basically in line with what was expected. Yields down just a little bit. The dollar down, really easing the way for stocks, risk assets to go higher. It's a broad-based rally. The S&P 500 having its best day in about 2 months. As for one stock that's really rallying in a big way, Capri Holdings up 54%. You can see this massive spike higher as we do have Tapestry buying the company or planning to buy the company for $8.5 billion or $57 a share, a little bit below that, suggesting that maybe some investors think that there could be some regulatory issues between these two luxury brands, but some real strength. Now, speaking of strength, yesterday we were, of course, talking about real estate, and we have some strength today. Brookfield up 2.2%, the multi-strategy manager. About 15% of their revenue comes from real estate. The CEO, Bruce Flatt, really making interesting comments saying that some of the best buying opportunities are ahead in real estate in a decade as rising rates and lending issues and values, lowering values, create an opportunity. WeWork bouncing back after yesterday's plunge, and then it's interesting, Alex, to see that these other office REITs, Boston Properties and SL Green, both also recovering yesterday. Interestingly, higher on the year, suggesting maybe the biggest and the best will survive.
Yep, you pointed out yesterday, like they were already doing not too poorly this year, too. All right, Abigail, thanks a lot. Really appreciate it. Abigail Doolittle. All right, let's get some insight then into our question of the day. Is the summer of disinflation over? For that view, we're turning to Ann Walsh, Guggenheim Partners Investment Management CIO. Ann, such a pleasure. Great to see you.
Thank you, Alex. Great to be here.
Okay, that's the question. Is the disinflation summer over?
Well, summer's almost over, and but disinflation is still going to be with us. But like so many of the trends that we're seeing, nothing moves in straight lines. And we can expect, because we've seen a push up in some commodities prices, that inflation will also, ebb and flow, and it'll probably go up a little bit in the next few months before it goes back down some more. Our view is ultimately we're going to see inflation continue on its trajectory downwards, and the Fed's really hard at work to keep trying to push down inflation to that target of 2%.
And what is the market not priced for, and does that make it the most likely outcome?
Well, I don't think the market is really pricing in sort of the next shoe to drop, and that's credit. Right now, the focus is on rates, and I always like to say, don't fight the Fed. It used to be a mantra for us for decades, but it seems like there's so many cross currents of information that are happening right now that really investors are trying to fight the Fed. And the Fed is very much focused on continuing to fight inflation. Mm-hmm. They're going to keep rates higher for longer, which was actually what we anticipated. And they're going to continue to work to slow down the economy. And frankly, I know recession seems to be off everybody's mind, but I think that that's probably a mistake at this point in time.
Do we get recession first or reacceleration in inflation?
We probably get a little reacceleration in inflation before we get recession.
Okay.
But they could come together pretty closely. And at this point in time, at least this morning, we got a benign print on CPI, so that's encouraging. But at the same time, we know the Fed's very focused on labor. And right now, the labor prints have been too strong, and the concern is that that's pushing wages up, and therefore that itself has an impact on inflation. So we have a lot of cross currents, as I said, in the data right now, and conflicting information.
And the equity market's really happy. It's looking forward. Everything's great. It's going up. And it's broadening out. What is the equity market seeing that you're not, and vice versa?
Well, the nice thing about the equity market is it can look very far into the future and be optimistic. And if I look very far into the future, I'm also an optimist. There's a lot of technology. There's a lot of very positive trends for the future. But in the shorter run, I think the market is not anticipating, as I said, the next shoe to drop, and that's credit and the concerns with regard to margins and pressures and a recessionary cycle. And I think we have to get through that first before we can get to what I might say the good stuff at the end of the story.
So everyone's worried about credit, but if everyone's worried about it, doesn't that prevent it from happening? In that, like, everyone has a dry powder and then they're willing to get in and jump in. Particularly if inflation is somewhat elevated, that changes the default cycle. What do you think?
So I don't really think that it changes the trajectory.
Okay. Maybe the timing?
It may change the level and the impact and where we find it. So we're talking a bit, we just heard about real estate. I think that the commercial real estate cycle is really still just emerging, particularly for office. And the cost of leverage is still high for borrowers. And all of these elements are still coming together and still have to form. And as we go through this cycle, we're going to definitely see the slowdown and market reaction will finally follow.
And we're going to live in a higher nominal world, though. Doesn't that cushion credit from the potential, the cycle that you would normally see?
For those borrowers and credit takers who have cash and have the wherewithal for repayment right now, they're going to come through the cycle pretty well. Creditors are going to have the benefit of being able to negotiate better terms. They're going to have the opportunity to get stronger covenants and investor protections. And in that way, credit, the best credits will continue to perform. The problem is the weaker credits, those that don't have a lot of cash sitting on the sidelines, that are not currently being invested at 5.5% in the short end, and they're not able to offset these higher costs of capital with reinvestment in cash instruments at this particular time. I mean, this is not a bad time for savers because you're earning some yield finally. It's a good time to be invested in high credit quality debt at this point in time, with maybe not so much concern about the level of risk in high credit quality credit relative to those credits that are going to be weak. And I've kind of coined a term for this year, idiosyncratic risk. What's really happening is it's the one-off credits, the cycle participants that you don't see that are going to start to build. And that's where we see defaults pile up and delinquencies start to increase.
But on the other hand, Alex, doesn't that speak to the idea that that's really good for big tech? So big tech has AI, which at some point is going to be fantastic. They've got loads of cash on the balance sheet, which is earning loads of money right now because effectively big tech is a saver. It's got some growth potential, but going into a slowdown, growth is going to be rare. Doesn't that all add up to some logic around why you want to own big tech?
Yeah.
There's all kinds of factors coming together here.
Right, and that's what tech is, right? It's a long duration growth play. And I mean, is Guy right?
So I think I'm going to paraphrase somebody else when they say that the markets anticipate the benefit of technology in the short run and under-anticipate its value in the long run. And I would suggest that this is exactly that story. In the very long run, I think technology is going to be a huge tailwind to our economy, to productivity. And so, yes, I'm very positive in the long run. I think there has to be a bit of a cycle cleanse from a recession and from a slowdown. And we have to get rid of the zombie companies, and we have to effectively do a little bit of a capital credit market purge on lesser credits before we can get to this next level and the next cycle, which I think will be a very strong and positive cycle.
Me? You?
In terms of, I'll go.
Usually we're coordinated.
We're not always that organized though. And in terms of, you talk about a recession. What kind of a recession are we talking about? A soft landing. Everybody loves the idea of a soft landing. We're almost talking about a no landing, soft landing. It's perfect. Where do you see that recession kind of kicking in? Is it a brutal recession? Is it a moderate recession? What kind of a recession are we going to see? And which kind of areas of the economy are going to be affected most by it?
So I think it's going to depend on where you sit in the economy as to how much you're going to feel it. I like the concept of a rolling recession where there are different parts of the economy that are feeling slowdown activity relative to others. So if you're in, for example, small office, commercial real estate in secondary and tertiary locations, you're going to feel a recession. If you're in artificial intelligence, as we've just spoken about, and you're in tech companies with a whole pile and a hoard of cash available to reinvest at this time, you're going to feel pretty good. And it's kind of a cycle that started last year. We saw manufacturing slow down, inventory reductions. We actually saw negative GDP, but nobody noticed. We saw, technology companies do layoffs that were pretty significant. We've seen crypto winter. Every one of these has been sort of a mini cycle of its own. And I think this kind of trend will continue. And so all of it will, end up being slow to no growth, but not necessarily the kind of, we're definitely not predicting a pandemic or global financial crisis type of scenario at all. There's strong balance sheets on the consumer. They have savings and wherewithal. And as I said, it's a good world to be a saver in. And finally, retirees have the ability to earn some yield. And I think that's definitely a positive.
So you're mentioning earlier about the idiosyncratic investing opportunity and how in the high grade credit market, like you don't have to worry about taking on the risk in the high grade market because it is really quite good. Where in that would you like the best if you had to rank it?
So right now, there's some great opportunities in structured credit, especially in the high credit quality tranches, AAA, AA. You can earn anywhere in investment grade, say from 5.5% to 6.5% in very high credit quality. The spread widening that usually happens in a slowdown economy or a recession is likely not to have a very strong impact on that space. This yield that you can obtain, it's very reasonable. You're finally getting paid to hold these bonds. We believe that it's not a bad time to take some duration in the portfolio. And we've been in a trading range for treasuries, so you can continue to take advantage of the trading range, somewhere between 3.25 to 4.25 essentially, and sit and wait on the sidelines for the next shoe to drop, as I said, back in credit, and for the opportunity to reinvest and redeploy into lower rated credits in the future once we've done sort of this a bit of a purge. So I think it's a really good time to be defensive and thoughtful and wait for the next opportunity set.
Do you short stocks in that environment? How do you play the stock market? Is the stock market the biggest disconnect from reality right now? The kind of environment you're painting, the story you're painting about this purge coming through, in terms of the big kind of asset buckets, where do you think we're going to see the biggest effect? High yield has been a really big performer so far this year. It's caught everybody on the hop. Equity has been a really big outperformer. It's caught everybody on the hop. Defensive's done less well. Kind of where are the extremes in this story that you think you want to be thinking about? You're talking about kind of in the middle, the defensive bit, but where's the kind of the flip side of that is going to be affected the most?
Well, we can't ignore fund flows, and we can't ignore the level of issuance. So in the high yield market in particular, we've seen a whole lot less issuance. So we do have some supply and demand action going on. And that is, there's still a lot of dollars chasing fewer and fewer bonds that are available. And as a result, that's created spread compression in credit, including high yield, where we've seen this tremendous performance this year. But it's also creating the same dynamic in equities. So there's only about 3,600 listed equities in the market today. And there's still a lot of money coming into the equity market, and as a result, it's still getting passed around to the largest market cap issuers and holders of those investments in equities. As a result, what we're seeing is demand for those stocks are going to continue as long as the money keeps coming into the system. There's just not that many listed equities, relatively speaking. So I think it's created its own kind of trajectory or story, if you will, in terms of market upside. Generally speaking, in a slowdown economy or recession, you can expect stocks to fall by about 20%, but now from a much higher level than we certainly started the year. And so maybe we retrace our steps, in a slowdown economy. It's not probably going to be the kind of real big downdraft that we might have seen certainly in the financial crisis or in the pandemic.
And it is so good to get your perspective, your thoughtful short-term, long-term perspective. Thank you so much for joining us. Good to see you in person. Ann Walsh, CIO at Guggenheim Partners Investment Management. All right, coming up, inflation burning your biscuits. We're going to find out how rising prices are eating into restaurant profits and your wallet. It's a real-time look at inflation in business. Laura Ray Dickey is the CEO of Dickey's Barbecue Restaurants. Coming up next, this is Bloomberg. When I go to the grocery store, I still feel a little sticker shock. Or when I go out to eat, I gotta say, $10 for a coffee and a croissant is a little crazy. But the official data did point to food price increases are slowing a bit. Natalia Knežević is here to break it down for us. Natalia?
Prices are slowing down, and I want to look at food away from home component. It is up by 0.2%, and it is the slowest pace of increase since March 2021. Let's flip up the board and look at some of the most important components when it comes to food inflation. We know that Americans love barbecues, and here's your barbecue basket. Beef and veal prices are still up month over month by 2.4%. For pork, prices are flat, and chicken prices are slowing down gradually, but it is a good trend. But if we put it in perspective and flip up the board again, so this is your chart for beef year over year, prices are still up by 17%. What it means for the industry, some companies, retailers or restaurants, they have to hedge those positions, and it costs a lot of money. So what does it mean for the industry overall? Let's compare the S&P 500 restaurants index versus the benchmark itself. And we see that restaurants year over year, they are down compared to the S&P 500 index. And Guy, basically, no matter how much Americans love barbecues, it all depends on the company's ability to pass along those costs on consumers.
It's not just Americans. Let me point that out. I love a barbecue. Brisket, we're going to talk a little bit about brisket in a moment. It's really hard to cook. It's really difficult to get right. Barbecues are fantastic. Natalia, thank you very much indeed. Natalia's Barbecue Basket. Let's continue the theme. Laura Ray Dickey, Dickey's Barbecue Restaurant CEO, the world's largest barbecue chain, joining us now to talk about this. Laura, let's just talk about what is happening here. We've got a situation where the CPI number is telling us that inflation is coming down. Does it feel like inflation's going to is coming down? Does it feel like inflation is going to continue to come down?
I think that what guests are going to continue to see is and feel that inflation for quite some time. So remember that we have been at an all-time high since last year. So we're really coming down from highs. Also, you have so many pressures in the market that restaurants have to absorb. The labor pressure, the cost of fuel, freight, all of those things also, not just the commodities market, not just what, brisket sitting at $4.17 a pound, which is, again, just slightly down from that all-time high in 2022. Pork sitting at about $1.69 a pound for consumers or guests directly. So we're coming down, but we're coming down from highs. And so we're starting to see some stability, but you're not going to feel that for quite a while with restaurants.
So, hey, it's Alex in New York. Is that because you're able to pass on price increases and that's stickier, or is that just because you need to pass it through to keep your margins intact?
Well, there's only so much that folks will pay for a barbecue sandwich. There's only so much that folks will pay for a brisket plate, right? So you do absolutely have that consumer tolerance, but you have to obviously protect margins. The business is good for some folks in the restaurant industry. For ourselves, we have 783 restaurants that are our traditional, our virtual, and our international. So we're able to do things in the market where, being the largest purchaser, for example, of beef briskets in the restaurant industry, serves us well. On the other hand, you have mom and pops or independents that would really, really, really struggle because they don't have those opportunities. But you, again, can only pass on so much cost. So you have to do other things. You have to shift to different focus on the menu. For example, for us, we are 82 years old. We started in 1941. And for the first time in our history, we took a menu reduction of over 41% of our menu. So we reduced items that just couldn't hold consumer tolerance for pricing or couldn't hold profit margin. So you do those sorts of things. And then again, certainly marketing, and it's the summer of pulled pork. It will be the winter of chicken, those sorts of things that we're able to do. But we have a wide enough variety in our menu to do that.
The winter of chicken. I'm looking forward to that. Laura, let's talk a little bit about kind of what your consumer is telling you right now. Clearly, inflation is something that has had a big impact. The financial markets are trying to work out what the biggest threat is right now. Is it more inflation or is it a recession? What are you seeing in your numbers that would guide us to what is happening here?
So I think I always like to start with the good news. So let's start there. That while we are coming off of incredibly high prices, we are seeing stability in the market. So again, while inflation is there, we're able to see cycles that allow us to go back and plan and be dependable. For example, you're seeing the type of natural market heightening that you would expect in all of our proteins at the end of summer. We should see some expected relief in that in September and October. And then you spike back up to the holidays, again, also when consumers can depend on that. They have a little bit more robust budget. And then we move into what we call lovingly in the industry that holiday hangover in Q1, where folks are tightening back up not only their waistlines, but also their wallets. And so when we begin to see those traditional cycles again, and you have stability, then that's always good news. Even if they are elevated as they are, even if prices are high as they are, and costs and pressure points are high, when you have stability long-term, then you can really make those long-term plans, investments, moves, different sorts of incentives incentives that I think is the good news in the market. That being said, what our guests are telling us is they are very, very, very price sensitive and value driven. They're feeling the same pressure the business is seeing. Their fuel costs are high just like ours are. There's, everything that they are being impacted by. They have to go out and purchase grocery store or restaurant every day in some form or fashion, more or less. And so they are being very driven by loyalty, by couponing, by value. We've brought back combo menus that we haven't had since the last large recession in 2008, 2009, because again, guests are saying, how can I stretch my dollar? Interesting thing to see is that folks, instead of just buying those value combos, they're also buying family packs. They're buying things that have leftovers so they can stretch that dollar even more. And that's very, very typical recession behavior.
Laura?
And something, yes.
Well, Laura, so the behavior is one thing, and I'm also wondering how it circles back into hiring, because when we speak to the NFIB head, for example, the real issue is still labor. Are you having just as hard a time today hiring a worker than you did a year ago?
We are definitely still having challenges. It is not as tight as it was a year ago, but it is definitely still there. To put that in perspective, for example, when we go to open a new store, you would hire 20 folks to open a Dickey's restaurant. We were able a year ago to only staff at maybe 12 if we were lucky. Now we're getting back up to that 14, 15, 16 mark. So it's still not where we were, but we are seeing some relief. We're also seeing folks that are coming back into more full-time schedules, which is a wonderful, wonderful news for the business. You're able to schedule better. So definitely tight. Labor is still a challenge. It is not recovered, but there is still folks that are now actually out rejoining the market, seemingly, in the labor market, as far as what we can see.
Laura, did working from home change people's behavior and how they consume food and where they consume? And is that still carrying on?
Very interesting question. Yes, it did, and yes, it is. So they really seem to, from a guest perspective, have those third-party delivery apps, delivery at large. You had that beginning as a trend, and now it has certainly become a lifestyle. So really, guests have gone from that being a trend to a habit, and that, even with the price on delivery, even with the additional costs, guests seem to have shifted to that, really placing that value on their own time and even on their own fuel. So they're more willing now to pay a set delivery fee, and there's certainly still, by and large, growth in online ordering and in delivery, and certainly even in third-party delivery, which actually has some of the more elevated costs in all of the different revenue channels direct to consumer. You're laying that on, but folks are still really growing there.
Okay. Laura, it's not the summer of disinflation, it's the summer of pulled pork. I'm very happy about
there you
that.
Go.
Thank you very much indeed for joining us. Laura Dickey, the CEO of Dickey's Barbecue Restaurant. Laura Ray Dickey. Okay, we're going to talk about the European close next. This is Bloomberg.
experts, great questions.
Thursday the 10th of August, CPI day in America. That's had a positive effect on stocks. Plus also the luxury sector is having a very good day here in Europe. China is going to allow tour groups once again to visit Europe. Names like LVMH are up strongly on the back of that. France, as a result of which, is outperforming. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So what's happening? Let's talk about these markets. Stocks are up. We're up by 0.8%. The stock 600 goes back through 460, 464 spot 24 is where we're trading right now. What is driving that? Luxury is a big driver of that. I would argue China is probably one of the biggest effects on what is happening here in Europe today, maybe even more so than what is happening as a result of the CPI print we saw out of America. So let's start with LVMH. LVMH is up by 3.5%. The reason for that, China is going to allow tour groups once again to visit the UK, France, Italy, you name it, as a result of which luxury stocks are going to benefit. That is a big pickup. You can see the benefit in the stock. Siemens, the engineering giant, yes, there's some issues with the digital business, which is not performing as well, but China, again, is another factor. So China boosting LVMH, China hitting Siemens. You can see the share price reaction in both of those two stories. China, as ever, continues to be a large factor for Europe. LVMH up by 3.5, Siemens down by nearly 5, Alex.
Yeah, I think that really points out what we experience here, right? Manufacturing versus services. You're going to go buy a bag. You're not going to go and spend money on a manufacturing facility. Okay, the S&P is up by 0.7. I should say we are fading the rally at some point. We were up over 1 percentage point. The biggest drag on the S&P is Tapestry. Talking about luxury retailer buying Capri for about $8.5 billion. Now, Capri owns stuff like Stuart Weitzman and Michael Kors. And Michael Kors has some turnaround problems. So there are issues that have to be dealt with. Also, this is the area of the consumer that seems to be the most strapped right now, not super high-end luxury and not discount. So I'm wondering the timing of all that. We'll break that down within the next hour. And crude is up down by 1%. I just wanted to point this out because you got strikes happening in LNG facility in Australia. You also have OPEC saying that you're looking at a 2 million barrel oil a day deficit because of Saudi cuts. You just have to wonder, if oil stays supported over 80, does that sort of infect the inflation picture in terms of sentiment and expectations? Yeah. Something to think about there. And then the 30-year auction coming out later today, so pay attention to that. You're seeing a little bit selling yields up a touch. But I bring up the commodity not just because I like commodities, Guy, but I mean, I understand you strip it out for core, but it's inflation expectations, right? Does that start to change the narrative again?
You, Mitch, on Friday, it's going to be interesting, isn't it? We're going to see exactly how the consumer's feeling. That's usually a big read-through from gas prices. That is something that we're going to be watching out for very, very carefully. Let's talk about the inflation data. Let's talk about the numbers we've had today. I know I was pointing at China just a moment ago, but this inflation data cannot be ignored, or can it? Let's talk about kind of where we are. This is the disinflationary trend that we've been watching. This is US core CPI, smallest back-to-back monthly gains in over, I think we continued that 2 years. What you've seen is basically that green area down there. Big drop down. We go sideways on core. Is this the bottoming out process? Is this kind of just the kind of sort of what you would normally expect at this point in time, i.e. the gains just get smaller and smaller and we're dealing with smaller margins? Or is it that actually things are bottoming out here and you're going to see a pickup back in inflation? Inflation's downward path. Does that continue remains a critical question here, Alex, and I don't know. There are plenty of people in the market believe there is a significant risk that inflation reaccelerates from here.
Yeah, and even if it's volatile, like what does volatile disinflation look like? How do you invest for that? We spoke to Catherine Rooney-Vera, Chief Market Strategist at StoneX, in the last hour.
Preparing for the worst. Because right now the markets are pricing in the best possible scenario. And as we know, that generally doesn't play out. There's going to be kinks in the road. So 100 basis points around there of cuts next year, in my view, is very unlikely to happen. Inflation could be sticky around 4%. It could reaccelerate or just not come down from 4 to 2%.
Takes us back to our question of the day. Is the summer of disinflation over? We were talking about in the last block the summer of pulled pork. I'd like that more, but is the summer of disinflation finally over? Let's try and answer that question. Claudia Panzeri, head of equity strategy at UBS, joins us now. Claudia, the equity market boom has been driven by equity market optimism that inflation is going to come down, it's going to be managed, we're going to see a soft landing, and as a result of which the Fed can be cutting and we're all going to be good. Does today's number confirm that story for you? What does today's number tell you about what equity markets have and haven't priced thus far?
Good afternoon, and thank you for having me. I think the market has priced quite a lot with soft landing scenario and disinflation as well. You know, we have been definitely positioned since March, end of March, and I think today data is confirming that inflation is falling, but the today data is not telling